Today's video is instructional in nature in that we're trying to help people who are interested in selling their mortgage to be able to analyze the factors that they need to consider before they agree on a price. Now, when I say selling their mortgage, what I mean is this is an individual or a small business or whatever that actually holds a mortgage and receives payments every month. This usually occurs when an individual has a business, and in order to help sell the business, which would include property, of course, that's why it's a mortgage, would take a down payment from the buyer, and either out of necessity or to make things easier, they determine that they will hold the mortgage for the rest of the price. And in turn, they basically become the bank, and they receive payments every month from that buyer who bought their business. Well, to go one step further, very often these people find out that they need funds after they've done this. One of the obvious places to get funds is to try and sell that mortgage. And again, it's the mortgage that they hold that they receive payments on. We feel that when people go to sell these mortgages, they should have at least a basic understanding of how a mortgage buyer is going to look at their situation in determining how much they will pay this person for their mortgage. Okay, with that explanation, let's talk about it. First of all, again, it's considered a mortgage sale. That is where we are purchasing a mortgage from somebody else. And a lot of times it could be they hold a mortgage, they can have variation of a mortgage called an agreement for deed or rent with the option to buy. There are several other names for them, but basically it's all the same. They are the mortgage holder on a piece of property. Like it says here, at some point in the future, after they've done this mortgage, they find out that they need to sell it. That's where we come in. One thing that we advise that a mortgage seller not do is act too quickly, especially with some of the advertisements that they receive in the mail or text or an email. And you'll know them when you see them because they have these splashy headlines, I call cheap advertising for lack of a better phrase, where it says, get cash fast, or top dollar paid for your mortgage, or nobody outbids us. These blanket statements that basically don't really have any credibility to the actual facts of the situation. We buy mortgages, and we've been buying mortgages for a long time, amongst the many things that we do. But we approach it differently, and this video is step one in a process where we like to educate these mortgage sellers, and they get the important parameters that they need before they say yes to somebody buying their mortgage. And you'll see as we go on, this can make significant differences in the amount of money you receive for a mortgage. Typically, when a person holds a mortgage and they call any company to buy their mortgage, it's bought at a discount, meaning it's sold for less than the face value. That happens for a variety of reasons. None of the mortgage buyers that are out there who are not licensed lenders can provide you with the same options that a licensed lender like Mortgage Investors Network can do. That's where you want to start. Most mortgage holders, they know that you can sell the entire mortgage and you can get cash for that mortgage. Like I said here, when they call, they know they can sell it. We've been dealing with these people for over 30 years and they realize that. But one thing amongst many that they are not aware of is you don't have to sell the entire mortgage at one time. you can actually sell a piece of that mortgage. In the industry, it's what we call a partial sale. How that works is we purchase a certain number of payments. We collect those payments. After those payments are sent to us, as soon as that's complete, the payments start going back to the original mortgage holder again. Another option you can use is, rather than a mortgage company or a mortgage buyer buying your mortgage at a steep discount, very often what you can do is you can go straight to the borrower and say, I'll give you a lesser discount if you go out and refinance this loan. We've done that many times, where we talk to the borrower and we say, well, the seller is willing to give you a discount if you refinance it, which we can do. So again, a non-licensed lender cannot do that. What I'm going to do here is I'm going to show you, using a fictitious scenario, the advantages and disadvantages of using one of these three options. And they are selling the entire mortgage at one time, selling a portion of the mortgage, which is a partial, or offering the borrower a discount straight from the mortgage holder to try and maximize the amount of money that mortgage holder is going to get. Selling the entire mortgage, selling a portion, or offering a discount to the seller. Here's our fictitious scenario. Mary owned a yoga studio, including real estate. She decided she was going to sell, which she put the property up for $325,000. A buyer came along, he put $125,000 down, and she decided, because he couldn't get financing for the bank, that she would hold the mortgage for the rest, which in this case is $200,000. So she's got a mortgage on the property for $200,000. And when she sold the property, she gave him the following terms. The amount again, $200,000, 20-year term, 4.5% fixed rate. Payments are $1,265.30, which includes principal and interest. Shortly after she did this, another business opportunity came up, and Mary called us and said, I want to sell my mortgage. What can you do for me? Let's look at our options. We're using her criteria, $200,000, 4.5%, 20 years at $1,265.30 a month. If we bought it, it would be $200,000 at 8.5% for 20 years at $1,265.30. Now we have a reason for the difference in the rates, which we'll go into. Okay? But in this particular case, that mortgage is worth $145,801.44. Okay, let's show you Mary's loan on my HP12C financial calculator. Let's plug in her terms. 240 months, 20 years, 4.5%. This changes it to a monthly rate. It was for $200,000, which we're going to plug into the value, and it will calculate payments, which are right there, $1,265.30. When she goes to sell it, everything stays the same except for the rate, which we are buying it at 8.5. So we'll substitute that in for the rate, and it will recalculate what the loan's worth, which is $145,801.44. That's where that figure comes from. Once she gets that money, that mortgage for her is gone. She will no longer receive those $1,265 payments. Because her rate is 4.5, and our rate to buy is 8.5. Even in that case, 8.5 is much less than your typical mortgage buyer, which is between 10 and 12%. Mary's mortgage has been discounted by the difference between what we're paying her and what her mortgage is at $200,000. That discount is $54,198 and some change. And again, that mortgage is worth less to us for a couple of different reasons. Very often, we know this from experience, the seller of a property, when they hold a mortgage, they pull a rate out of midair. It has no bearing on the customer's situation, but it looks enticing. It's priced the same as, say, residential mortgages that people see every day, and it's a very attractive inducement to the buyer to move forward because the seller's given them a good rate, a rate that they wouldn't be able to get anywhere else. Okay? Not only that, but when we look at a mortgage to purchase, very often they don't have even the basic financial statements that we would need to show that that customer is a creditworthy borrower. They simply look at the situation as, we're selling it for $325, he's putting $125,000 down, and I got a mortgage on a property, so I'm going to do it. And very often, that's the extent of their criteria. Okay? Also, in certain cases, it's difficult to see how that borrower is paying, because sometimes they'll pay in cash, or they'll make payments and the mortgage holder doesn't really keep track of when they got the payments and when they went to the bank, so on and so forth. The lack of this crucial basic information makes that request riskier. Hence, the rate is 8.5. In some circumstances, the seller of a mortgage might be perfectly fine with this amount. It depends on what the opportunity is. And also, they don't have to wait many, many years to get all their money back. So in certain cases, we've seen where sellers are fine. Let's say in this particular case, though, that Mary sees the amount and she wants to know if we have other options, which we do. In a lot of cases, some of these mortgage buyers that are out there, especially the ones that send these little flyers in the mail, they might not have any other options that a licensed lender would have. So let's touch on those options real quick. After she sees how much cut to her value she's going to take of $54,000, she says, well, I don't need the whole $145,000. I don't need that much. So when I hear that, I say, well, perhaps a better way to do this would be, we'll buy a certain number of payments from you. And in this particular case, as an example, I say to her, how about we buy 10 years worth of your payments? If we do that, you're using 8.5% again, you're going to walk away with $100,000, which gives her some cash she needs. Okay, now we're going to show you the partial sale. Again, we're going to put in the original information from her mortgage that she gave the buyer when she sold the yoga business. 240 months or 20 years. She originally was selling at 4.5%, and it was $200,000. So payments are correct, so everything is in there correctly. Now, if we are buying it 10 years worth of payments and we're charging 8.5, plug that in as well. Now we're going to find out what that's worth, which is $102,052. That's how we calculate partial payments. Here's the difference between a portion or a partial and selling the entire mortgage at one time. We're going to give her $100,000 and we're going to collect 120 payments. When it comes time for the 121st payment to the end of the contract of 240 payments, those payments are going back to Mary. She gets $100,000 when she sells the first 120 payments. Then the second $120,000 payments, she's going to be collecting those payments on a balance of $122,892. After we get our payments, she's still owed $122,000. So you can see she makes a lot more money on this option. It's roughly almost $223,000 she gets out of the situation, as opposed to selling the entire mortgage at one time at $145,000. This may or may not work for her, but it's obviously a good option. She takes less now, but if she's willing to wait 10 years, she's going to get a lot more for her mortgage. Now let's go to the third option. We say to Mary, okay, if you want to sell your mortgage, you might want to go to the person who makes the payments. In this particular case, you call them and you say, listen, I'll give you a $30,000 discount. That's an arbitrary figure. It could be 20, could be 15, whatever the case may be. If you go out and refinance this and pay me off early. Once we suggest that, if she's willing to look at that scenario or that option, we ask her permission to talk to her borrower, and we can go back and we can work with that borrower to potentially refinance it. If that's the case, then she's selling the entire mortgage and she loses $30,000 as opposed to $54,000. Now in this particular case, she said she talked to the borrower at one time, and the borrower asked her if she could advance another $50,000 on the mortgage. In other words, get some of the money back that he put down. Like we've said in other videos, entrepreneurs or people who run businesses very often have the need for cash. She was not able to help him with that because she did not have the extra cash. Okay? But when she mentioned that, it gave us the idea that, hey, maybe what we can do is you give that borrower a discount, we'll contact the borrower, and we'll see if we can't turn around and refinance the loan and give him his $50,000 on top of it. Which, if that sounds reasonable to her, she would call the borrower and say, this is what we're proposing. I can have Mortgage Investors Network give you a call and see if they can fill that role to get everything done. Refinancing the property and getting them the cash they need. In this case, we talked to the borrower and they couldn't go to the bank to refinance that property yet because they just bought the business and they haven't had it long enough. The business was, we feel, sold for really actually less than it was worth, so we're going to turn around and refinance it and give him the $50,000 that he needed. So even though our rate was 8.5% and the rate they were paying was 4.5%, they're still doing okay because they got a $30,000 discount. And by looking at their information, we know that in the next year or two, they're going to be able to go to either back to us or to another lender and get a lesser rate. Okay, so it would pay for them to do this. Okay, in this particular case, being flexible, being a lender, and actually educating all parties a little bit ended up being a win-win for everybody, which she gets a better yield on her mortgage. She has less of a discount. Mary walks away with $170,000 for her mortgage. The entire lump sum is $170,000. She was happy with that. The borrower was happy with it, and it was a win-win, like I said. These are only 3 options. There are many more options involved, but I didn't want to go into that kind of detail. Here, the video would be an hour long. We'll sum it up by saying this. At this point, you should be realizing of all the people that buy mortgages out there, only a few of them are licensed mortgage lenders. And that provides the seller of the mortgage with many more options, which, as you can see here, these options make a big difference in dollar amounts. This particular mortgage to be sold is only of medium size. Sometimes we're dealing with mortgages for $500,000, and the repercussions of these different options are even more exaggerated. A lot of the people out there who buy mortgages are not lenders, and all they can do is offer you a simple cash amount for your mortgage. Very often their rates are 10 to 12%, which would mean she'd take an even larger discount, to say the least. In our particular case, it's our money. We don't have to go to somebody else to make these decisions. There's no brokers, no non-mortgage type of buyers, no middlemen. What that results in is we can give you a higher bid for your mortgage, less costs, which means a larger yield on your mortgage. Also, another thing that's very important. When you're selling to a licensed lender and you've done a partial sale, that means that the lender who bought those 120 payments is dealing with your customer for 10 years. So it's important that that borrower deal with people who are educated and licensed and are governed by regulations. Makes you realize that this is an entity that's going to take care of your borrower. That's really important, because if your borrower runs into hardships, how the person who bought those payments handles those hardships is ultimately going to have a big effect on you when you start collecting those payments again. Always best to deal with a licensed entity in these cases. Don't forget, that borrower, even though you sold the payments, they are still your customers. So you want somebody dealing with your client or your customer who is regulated, has experience, and is licensed. To wrap up, I've listed some common reasons why a person might want to sell their mortgage. At the time you did the mortgage, it was perfect financing tool to get that property sold, or that business sold, including the property. But since then, other opportunities come up, some of which are too good to pass up. So very often, they sell the mortgage to take advantage of those opportunities. Another reason people sell their mortgage is they're having payment problems. The borrower's situation has deteriorated, especially these days. A perfect example is COVID-19. Look what quarantining their customers has done to a lot of small businesses. Payments might have fallen behind. Insurance has lapsed. They can't afford to keep insurance on the property. They can't afford to pay the taxes. Very often, when they run into these problems, they don't necessarily know the proper way to get that fixed. So very often they'll start calling around looking to sell their mortgage. When they contact a company like ours, we deal with this type of stuff, and we're in a better position to help them work it out than your typical non-licensed mortgage company buyer of mortgages. Regulations change. They change every day. What was the rule a few years ago has now drastically changed. I'll give you, for instance, you hold a mortgage on a property you sell. Typically that mortgage is exempt from most or a lot of the mortgage regulations. However, if you refinance it, that could put you in a position where it has to be done following all the regulations. A lot of people who hold mortgages don't understand these type of nuances, and it could get them into some trouble. It could jeopardize their collateral. Speaking of collateral, last point, property is neglected. Market value has dropped. Your collateral value has dropped due to neighborhood problems. The borrower passes away. All these sort of things are some of the reasons we see why people call us up and want to sell their mortgage. So you need somebody who's creative to help you get the best return on your mortgage, even in bad circumstances. I guess the bottom line is, why trust something this important to somebody who is not in the lending business, especially not licensed in the lending business? It's amazing the people who are out there buying these mortgages. We've got people who take classes over the internet. They'll spend $350 or spend $1,500 and learn about buying mortgages over a weekend seminar in a hotel somewhere. Okay, then they start putting out their advertisement, especially the ones that say, have those flashy headlines, nobody beats our prices, get the money you need, and so on and so forth. They basically have very little experience. They would not be able to give you these options. Okay? And then you've got some of these private people who have been doing this, who basically prey upon mortgage holders' hardships. And they know that some of these people are in a difficult spot, and they charge 10, 12% for their mortgage, just because they're desperate. I wouldn't advise dealing with those sort of people. We would prefer to show people some of the essentials they need to know. before you sell your mortgage at a huge loss. At least give us the opportunity to analyze it and to provide some flexible choices. Give yourself a fighting chance. All we ask, give us a call with your scenario. We can usually get back to you within 2 or 3 hours with all of these type of options, if not more. Okay? So we hope this video has enlightened you on some of the intricacies that are involved in these type of transactions. And we hope that when the time comes, you'll include us on your list of companies that have a potential to bid on your mortgage. I know a lot of this information is technical, but you can watch this video, reread it as often as you like, and if it raises other questions, don't hesitate to call us. Okay? Thanks for watching. Appreciate it very much.